Hello everyone, welcome back to the course Financial Mathematics for Actuaries. We are in the final week and we are now summing up and reviewing whatever we have learned in the previous weeks, that is from week 7 to week 11. Okay. So in the previous session we have already reviewed the topic about the loan repayment methods, and there we have also remembered whatever we have learned, that is the uh, how to compute the loan balances using the prospective methods and retrospective methods, and also what is the loan amortization method and what is the sinking fund methods, and so on. So today in this session we are going to review the topics related to bonds, okay, and bond pricing. Okay, so let's begin now. So remember why firm issues bond, right? So why basically the firm issues bond? We have started with this, okay, and we have understood that firm issues bond to raise fund, okay, or to raise capital, mostly for the long term project, okay, or its expansion of the projects, or acquisition, or to refinance the existing project, or or more expensive debt. Okay, so remember that how to raise fund by a firm. Okay, if a firm want to raise fund, then it has two ways. One is issuing the shares, for which it has to dilute its profit, okay, with the shareholders, right? That means the shareholders are eligible to take some of the proportion of profit from the firm. The other way is to issue the bond, or to issue the debt, okay, or borrow the money, right, for which the firm need to pay the interest amount and also the principal, but the firm does not dilute the profit. Okay, but even if the firm is not profitable or a chance of bankruptcy, the it is obligated to pay the periodic interest rate and the principal amount. That you have already understood. Okay, fine. So what is a bond then? Again, like, bond is a fixed income instrument, okay, or a debt instrument, right? Bonds are basically the fixed income instrument issued by the company to raise fund. Remember that whenever the company wants to go public, then only it issues bond or it issues stocks, right? Okay, if it does not want to go public, then it does not do so, right? Okay, so the bond represents a borrowing arrangement, okay, carrying a specific interest rate or the coupon rate, meaning that whenever a firm issue a bond, it is obligated to pay the periodic interest money, okay, and the principal money, right? And of course, if you are a bond holder, okay, if you are a bond holder, then you get the first priority, okay, to claim the company's asset if any chance that the company goes bankrupt. Okay, so the bondholders are the or bondholders will get the prior benefit, okay, than the shareholder to claim the company's asset. Okay, so what are the types of bond? Remember, we have also discussed several types of bond, okay, and there we have discussed, depending upon who is issuing the bond, we can like understand that whether it is issued from the government or issued by the government or issued by the corporation. Okay, accordingly we have the name, right? So government bonds are basically issued by the government, mostly central government, state government, sometimes municipal also issue such governments. And we have also understood, okay, I have once briefly explained what is bills, what is notes and bonds. Okay, so government bonds are either bills, notes or bond. Bills means very short term government bond. Okay, it is mature within the 1 year term. Okay, if the bond is for like 2 year to 10 year term, then usually it is known as notes, right? Okay, and more than 10 years, okay, time to maturity, then we will generally call government bond. But we have understood these bills, notes and bonds for all the term in one basket, that is government bond. Okay, that's what we have done, right? Okay, so bond issued by the corporate or the private corporations are usually known as corporate bond. Okay, and we have also understood that government bonds are relatively risk free. Okay, mostly they are default free. Okay, but corporate bonds are risky bonds, they are not default free. Okay, they are not default free, right? Another type of bond we have understood was secured bond. Okay, what do you mean by secured bond? Secured bonds are secured by the collateral assets. For example, mortgage bond, right? So you are now depositing some like valuable assets as collateral. Okay, that is secured bond. Okay, and on the other hand, there are also called unsecured bonds, or we call it as debenture. So debentures are also bond, but they are unsecured bonds, they are not secured by any kind of collateral deposit. Okay, then again we have understood what is coupon bond. Most of the bonds are actually coming up with a attached coupon rate. Okay, so bonds that pay a fixed rate of interest throughout its return or throughout its term to maturity is basically known as coupon bonds. Most of the bonds are the coupon bonds. Okay, unless and until it is specifically mentioned, or a kind of bond which is known as zero coupon bond. Okay, so zero coupon bond does not have a coupon bond, or sorry, coupon rate. Okay, bonds make no interest payment until the bond matures, but most of the time the bond actually like available for a discount, like at a discount. That means, and you will get a little bit higher price when it matures, right? So for example, a 1000 rupees par value bond may be selling at 850 or 900. Okay, usually the like selling price is less than the par, and we know that this type of bond are discount bond. Okay, right. So another type of bond, okay, another type of bond what we have in fact discussed mostly based on the corporate bond are callable bond, right? What are the callable bond? Callable bonds are the bond issued by the company, okay, which may be called for redemption prior to the maturity date, right? So the company can call for redemption prior to its maturity date. Okay, and the right to call often rests with the company, right? And because the company, okay, can call it any point in time, okay, it involves which is a risk called call risk, right? Okay, usually this is the reason the firm has to offer a higher interest rate for such type of bond. So the callable bonds are usually associated with a high call risk and therefore high return also, or high interest rate. Okay, So firm issue it to take advantage of lower interest rate in the future. So whenever firms like predicts that in the near future the interest rate may be declining or may decline, and therefore like it can redeem it and issue new bonds in the lower interest rate to take like to take this type of advantage. Firm usually issue this callable bond. And why people invest in callable bond? Because it is usually associated with a higher return, right, or higher interest rate, right. It attracts investors. Another type of bond is convertible bond. So a firm can also issue a bond which can be converted into equity shares in the later date, right. So bonds that can be converted into equity shares, okay, in the future, right. And the right to convert it often rests with the bond holder. Okay. So if you are a bond holder, then if you are holding this type of bond, then you are eligible to convert it into the equity shares in the later stage. Okay. And usually for this reason, this bond does like have less interest rate. Okay. So the convertible bonds usually have lower interest rate than the callable bond, right. Then the why the firm issues such type of bond? Obviously, the firm issues this type of bond. One reason is that it has less interest rate, and also the firm like want to take advantage of like delaying the dilution, right. Okay. And why investors want to invest it? Because it is an advantage of converting into shares. So if you believe that the company is doing well and like may be profitable, and therefore converting into share may be more beneficial for you. Okay. In such case, you want to hold the convertible bond. Okay. So we have clearly like understood what is the callable bond and what is convertible bond, and therefore we have also understood various types of bonds, right. Now let us also review what we have like learned, the concept of asset valuation, or specifically we have learned here the bond valuation, right. So in which we have started with learning the current yield, or the running yield, or we will call income yield. Okay. In this slash here, therefore we can write it here income yield also. Sometimes this type of yield are known as income yield also. Okay. So the current yield can be measured as the total interest amount divided by the current market price, okay, multiplied by 100. Okay. Or we can simply write it as FR. Okay. Like R is the coupon rate and F is the face value. So we can simply have like FR, that is the coupon amount or the interest amount divided by the market price multiplied by 100. Okay. So that is the current yield, right. So the current yield would be higher than the coupon rate when the bond is selling at a discount. That means whenever the bond is selling at a low the price lower than the mature or redemption value or the face value, then we will assume that current yield should be higher than the coupon rate. Okay. On the other hand, the current yield would be lower than the coupon rate when the bond is selling at a premium, right. Okay. So and one of the limitation of this current yield is that although it is easy to compute, okay, it ignores the time value of money, right. So the calculation of current yield ignores the time value of money, and therefore it is not very popular, right. So another term we have understood was the yield to maturity or YTM, okay, which is a most like used measure of the rate of return on bonds. Okay, most of the time the yield we mean is actually yield to maturity. Okay, so it is the internal rate of return or IRR earned from holding a bond till the maturity. That means if you are now purchasing a bond and holding it till maturity, then how much worth the bond actually is calculated to be is basically known as the yield to maturity, right? And this yield to maturity is the interest rate that make the present value of the cash flows receivable from owning the bond equal to the price of the bond, right? And therefore it also incorporate the time value of money, the limitation what we have seen in the current yield method. Okay, so that limitation is not there in the yield to maturity calculation. Okay, so it is the solution for R in this following equation. So remember that the market price, okay, is equal to the cash flow in one period, like the cash flow in one period divided by 1 plus the interest rate or the required yield, okay, plus okay cash flow occurred in the second period, okay, divided by 1 plus r to the power 2, and I will go on, okay, and then okay in the last m is the maturity value, okay, divided by 1 plus r to the power n. Now if you will solve this r here, okay, we will solve this r here, that r is basically known as the yield to maturity. Okay, we have already done it, okay, using the trial and error process, okay, putting different values of this r or YTM, and then we have like calculated it using one numerical example, and I have also given one approximation formula to compute the yield to maturity, right? Okay, so this equation also can be written in this summation. Okay, so it is a market price is equal to FR summation of 1 upon 1 plus IY to the power j, okay, plus C divided by 1 plus IJ. Okay, C is here the redemption value, right? C is here the redemption value, which is assumed to be equal to the face value. F is the face value and R is the coupon rate, and therefore FR is the coupon amount or the the interest amount, and here IY is the yield to maturity. Okay, upon compute like solving this IY, we will get the yield to maturity that we have done. Okay, now okay, we have also concluded from this yield to maturity calculation that YTM is greater than the coupon rate for a discount bond, and YTM is less than coupon rate for a premium bond. Okay, and I have also given you the approximation formula, okay, because the trial and error process will take long time. Okay, you please remember these formulas, and I have also told you that most of the time, okay, some book actually and also your internet or simply people consider this denominator here is that m plus p divided by 2, but like I believe this formula will actually give us a better measurement than the formula what we have considered. Okay, so YTM is approximated to be C plus m minus p divided by n, okay, whole divided by 0.4 m plus 0.6 p, in which case C is the annual interest payment and m is the maturity value of the bond and p is the current price of the bond. Okay, right. So now let us understand the bond price. Okay, we have already done that. We are simply recalling whatever we have learned. Okay, so Now, the basic bond price formula we have learned was P is equal to FR A angle NHI plus M, okay, V to the power N. Here I have already mentioned, like M is also like understood as C, which is the redemption value or the maturity value. I have considered maturity value, so I have simply put M. Okay, right. So what is the relationship between the coupon rate, required yield and price? Then we have already understood that bond price like has inverse relationship with the yield of the bond, right? There is an inverse relationship between the bond price and the yield of the bond, right? Why it is so? This is because as the required yield, okay, increases, the present value of cash flow decreases, right? Wherever the required yield will increase, the present value of the cash flow decrease, and therefore the price also will decrease. On the other hand, whenever the required yield decreases, the price or the present value of the cash flow will increase, and therefore the price should increase, right? This explains the inverse relationship between the price of the bond and the yield of the bond. Okay, so what is the relationship between coupon rate, required yield and price then? Okay, just sum it up that coupon rate is greater than the required yield when price is greater than par. That is mostly for premium bond, or you can simply say that for a premium bond, coupon rate is assumed to be higher than the required yield. Okay, for a premium bond, coupon rate is higher than the required yield, or you can simply say that whenever the bond is having a higher coupon rate than the required yield, then that bond is said to be a premium bond, or mostly it happens for the premium bond, in which case the market price is less than the face value or the par value. Okay, on the other hand, the coupon rate is less than the required yield when the price is less than the par or this happens for the discount bond. Okay, so whenever the coupon rate is less than, okay, or required yield is usually higher than the coupon rate, then that is for the discount bond. Okay, so coupon rate is equal to the required yield when the price is equal to par. So whenever price or the market price is equal to the face value, then the coupon rate must be equal to the required yield.